PwC in 2007, and as I mentioned, is currently working as a partner with over 17 years of experience in taxation matter in both domestic and international tax of large and the varied client base. The engagements involved conceptualizing tax-effective alternatives, evaluation and minimization of tax exposure in business transactions, restructuring, acquisition, divestment, tax due diligence for acquisition and investment strategy on audits and tax litigation, effective compliance control models, and tax risk management frameworks. There is always a distinction between tax planning, tax evasion, and tax avoidance. So, we able to answer those. He's a regular speaker at course, which is
so your voice is cracking.
yes,
Sorry to
Dr.
disturb.
Ranjit.
So sorry
The
to
voice
disturb.
is cracking, sir.
Okay. Are you able to hear me now?
Yes, sir.
Yes, sir.
Okay. So Nitin is a regular speaker with ICI and particularly speaks in the International Taxation Certification course. He has also authored a book with LexisNexis on tax withholding laws. He qualified as a chartered accountant in 2000 and then became a member of ICI. He also holds a bachelor degree in commerce in 1996 and bachelor degree in law in 2012. So we welcome you, Nitin, and would request you to kindly take this session and enlighten our participants. Thank you very much for joining. Over to you, Nitin.
Thank you, Sanjeev ji. Thank you, Anjali ji. Very good morning, all. It's my pleasure joining this session and sharing my perspective on foreign remittances and application of withholding tax. And I have my colleague Akshay Anand also joining over here. And certainly the topic which we have taken has many nuances in the sense that somewhere either these provisions are going and checking the charge of the tax and somewhere recovery of the tax, and then there are nitty-gritties around how the process runs, and therefore I would rely upon my colleague Akshay, who would certainly share some information in detail for the benefit of audience. Uh, uh, and thank you, Sanjeev ji, for this introduction. And maybe we can start with the presentation. If you have any doubts, kindly make note of it. Either we can take the questions at the end of the presentation, or maybe if it is absolutely necessary, then certainly you can ask the question now, then and there only. And then we'll try and address it in between, or maybe we can take it up the questions at the end of the presentation.
Excuse me, sir. Sir, while your presentation is going on, the questions are going to come in Q&A box. If you want to answer them, then it is fine. Otherwise, once the session is coming to an end, me or Dr. Anshika will take up the questions, sir, and you can answer. Both of them, we'll keep a note of it, sir.
Thank you, Anjali ji. Thank you.
If you want to do it simultaneously, sir, they'll be appearing in Q&A box and chat box that is visible to you also. You can take up from there also. Thank you, sir.
Then I think it makes sense that we have the protocol set, so we should follow that protocol. We'll take it up all the questions at the end of the presentation.
Okay, sir. Okay, sir. We'll keep it that way, and I request all the participants to keep their question and answers at standby for the time being at around 10:30. Sorry, we are at around 11:30, where they can start writing down their questions in the Q&A box so that we can take it, sir. Is it okay, sir?
Yeah, absolutely.
Thank you, sir. So question and answers, keep them at standby. I request all the participants, we'll have it at around 11:30. Thank you, sir. Over to you.
Thank you, Anjali ji. So, friends, the topic is foreign remittances, and before we go deep into the presentation and this topic, to share a perspective that in India, when you make a payment to a foreign source, foreign party, a foreign company, as the case may be, the law, income tax law, kicks into the picture, and you are required to look into the transaction or the payment in more detail, so as to check that are there any obligation on you as a payer to deduct the tax and deposit with the government, and that is where this whole provision comes into the picture. And it's a very simplified narration to say that that I am making a payment to a foreign company for uh, say supplying software in India. Then should I withhold a tax on those software payments? And then when you really try and check the obligation to withhold tax, then what nuances would come into the picture? What obligations would you have? What consequences you may have if there is a default? This whole paradigm we have tried and captured in this presentation. Uh, I'll, I'll I'll make it simple. My and Lakshya's attempt is to make this whole subject and present it in a simplified manner. Uh, just one thing, that when we talk about the taxability of the transaction and why we are looking at taxability of those payments, for example, the example I gave, that payment of software, there could be many nuances, many dimensions. So we'll not touch all the dimensions of taxability of a particular transaction, because that would be a subject in itself. So we'll keep the discussions at a high level, at least those necessary points which a payer has to know before making a payment and before discharging its obligation of withholding tax. So we start with principles of taxation, and as you may know, and that how the income tax framework functions in India. There is a one residence-based taxation, and then there is one source-based taxation. So residence-based taxation means, say, a country can tax person, say, like we have Income Tax Act 1961, where a resident is taxed in India on its global income, whatever source, whatever geography it is coming in, it is taxable in India. And then even on a foreign companies, if they have any say business transaction in India, then there is a concept of permanent establishment, which seeks to create a departure from source based and takes it to a residence based because of because attaching some permanency there, and we'll capture that a bit later in this presentation. And like companies in India, so they are liable to pay tax on the basis of their incorporation. And now there is an embedded rule where not only incorporation but place of effective management, if that situates in India, then the company is liable to pay tax in India. An individual, like we spoke about, that it is not based upon citizenship but based upon the tax residency. Essentially, Section 6 speaks about that how and why a person can be classified into three categories. One is resident or a non-resident, and one in between, a resident but not ordinary resident. So we'll not go on in those complications, but for the purpose of this discussion, it is relevant that how the taxation would govern the situation, would govern the payee, the recipient. Like residence-based taxation, we have source-based taxation also, and essentially that links to the foreign nationals who are coming and transacting with India. Then the age-old principle of income accruing or arising in India when is being defeated, or when is not being found sufficient to capture certain stream of income, especially with foreign nationals who are transacting with Indian nationals and earning revenues. but not certainly falling in those accrual or arisal, then some deeming provisions are provided under the law, and we'll take you through broadly in through those deeming provisions also. So that is the whole principle of taxations which have been followed across the globe, and in India we have both exist in the statute book. Overview of taxability, why taxability is required. So section 4, I would say that is the origin of this whole statute. And whenever the legal mind stuck somewhere, then they try and check that how section 4 is really helping in interpretation of a particular situation or an issue. Section 4 provides the charge of income tax, and if there is no charge, certainly you can't apply income tax. The Constitution of India is very clear in its wisdom that the Article 165 says that there is no authority with the government to recover taxes without the authority of law, and that authority comes from the income tax law. And section 4 provides that how the income tax shall be charged. And section 4 subsection 2 provides that if you and I are liable to pay tax in India as per section 4.1, then that has to be recovered by the government. And then how the recovery would happen, either I should and you should pay the advance tax, or that amount is to be recovered by way of withholding tax, which is called in the income tax law as tax deducted at source. So there is no concept of withholding tax in the Income Tax Act. It is referred to as tax deducted at source. So section 4 encompasses the charge as well as the recovery both, and recovery has to be either by advance tax or by tax deducted at source. So this charge and machinery both go hand in hand. If there is no charge, machinery cannot kick in. If there is a charge, but there is no machinery provision provided for recovery of tax, then somewhere it has been seen that that defeats the charge as well. Thereafter comes in section 6, and I would say before that section 5, which says and defines the scope of income, how income is to be taxed in India for a different, I would say, different class of person. Like for resident, it is global income to be taxed. For a non-resident, income accrue or arise in India. Essentially means where transactions are taking place in India. And also income which are deemed to accrue or arise in India, meaning thereby where the payer is an Indian national. So those are classified. In case of a non-resident, its global income is not taxable in India. Otherwise, it would lead to anomaly in many situations, and therefore the taxation for non-resident is kept only for if those transactions are happening in India, or if those transactions are not happening in India, but payments are being made by a resident of India, like you, I, also any Indian company, then subject to certain conditions, those are classified as taxable in India. And then there is a determination of residential status, that whether you are liable to pay tax on a global income or only on certain classified income, depending upon your residential status. How that residential status is to be determined, that comes in section 6. And then we have section 7 to 9 giving instances of income deemed to accrue or arise in India, where a deeming fiction has been created by the legislature. As I said earlier, that wherever certain transactions leading to income earned by foreign nationals, but the scale of income accrue or arise, meaning situs of transaction in India, was not being complied there, and therefore the government introduced or relied upon essentially section 9, where they have provided deeming fiction for income deemed to accrue or arise in India, where payer is situated in India. So we'll deal with these aspects also broadly in the ensuing slide and make it more simpler. So overview of taxability, like I said that income is chargeable to tax in India. If you see the red bar above, the income is chargeable to tax in India only if, so these are the two conditions what we have to see. And now we are confining ourselves to a non-resident because we are dealing with the subject which is foreign remittances. So now we are moving away from the resident taxations to non-resident taxation. And to see the taxability and why taxability, that like I said, that if there is no charge, there is no recovery, and that has been also found place in section 195, which will come in subsequent slides, which governs the TDS provision for payments to non-resident. So income is chargeable to tax in India only if these two conditions are satisfied. The below two bars, one at the left hand, derived from presence in India. The foreign company has a presence in India. And if that is a presence, then we need to see that whether that presence could create a business connection. And business connection is a term which is defined in the income tax law in section 9. And there is a catena of judgments where the term business connection has been interpreted by the judiciary. And then there is another term which is called permanent establishment, which is principally comes from the double taxation avoidance agreement. And for the sake of today's discussion and the presentation, I would try to say double taxation avoidance agreement as a tax treaty. So as per the tax treaty, there is Article 5 where the term permanent establishment is defined, more or less in a similar manner in all the tax treaties, subject to some gaps depending upon the treaty where you are looking at. Generally, this permanent establishment in tax treaty and business connection in the Income Tax Act stands on a same footing. Just that business connection is a very wide term, and permanent establishment is a narrower term when you really do a comparison and determine the taxability basis the presence of a foreign company in India. And the tax rate on foreign companies or foreign nationals are at 40%. And then that additionally have education cess and surcharge, and that takes it to close to 42%. On the right-hand sidebar, if you see that if I don't have any presence in India, I means a foreign company, a foreign national, then should I assume that I am not liable to pay tax in India? But then I have to see the taxation which is coming basis the source-based taxation, whether it is Income Tax Act 1961 or even under the tax treaty, there are certain articles which takes care of source-based taxation. So I need to see whether I have any source from India. Generally, the source is if the payer is a resident. And then there are certain qualifications attached here too. And typically, the income streams like royalties, fee for technical services, interest, and dividend, those are considered as source-based payments. And typically, the implications arise around these 3 or 4 income streams. If these are taxed on a gross basis, then a tax rate is also provided. These are not taxed on a net income basis. That means that you take care of revenue and then take account of expenses incurred, and then on the net profit you pay tax. Whereas in the latest presence that residence-based taxation like permanent establishment and business connection, the taxation comes on a net income basis, and here the taxation come on a gross basis. So take example that I took some technical services from a foreign company. The foreign company did not visit in India, but provided all the technical services either through, say, video conferencing or over a web-based communication. I availed all the services and paid, and now I need to pay that amount to foreign company. So in that case, that foreign company did not have any presence in India. So then I need to see whether source-based taxation could capture that situation. And if it is classified as technical services, then say, so for example, I need to pay 100 rupees. The 100 rupees shall be liable to pay tax in India. No deduction shall be allowed. And if the tax rate is as per, say, section 115A, which provides tax rate for technical services, or the relevant tax treaty, whatever the rate which is more beneficial shall be provided, say typical 10%, then 10% will be applied on the 100 rupees payment I would make. Applicable cess and surcharge would depend on whether I'm borrowing the rate from Income Tax Act or the tax treaty. We'll take that discussion also, that should the treaty have education cess and surcharge also. So this is the sum and substance, that that if taxability of a foreign company would come, and then how I need to see. And we have tried to make it more complicated by giving this bar chart, but frankly, when you would practically try and evaluate the transaction and the taxability, it would be much more cumbersome. Let's try and decode this this chart. At the top, you would see that payment to a non-resident. You are making a payment to a non-resident. Then first you have to see that whether this is taxable under the Income Tax Act. So that is the Bible we have, which we have to go through. If the answer is no, and you have seen, you have analyzed all the provisions of the Income Tax Act, and then you have found that it is not taxable, then on the right hand side you would see that if it is not taxable under the Income Tax Act, then there are no obligation on you, no tax is required to be deducted. So you will directly come to the last point of no tax deducted. If your analysis suggests that yes, the payment is taxable under the Income Tax Act 1961, then you will move towards the left hand side, and then you will have to analyze the DTAA or a tax treaty, whether tax treaty also provides taxability of that transaction. If the answer is no, you will end up having the same result. No tax is required to be deducted because income is not taxable in India. So I'll take a step back and just to add a perspective here, that in the Income Tax Act 1961, there is a section 90, and which brings the tax treaty into the Income Tax Act, and that is a window where the provision of tax treaty comes into the Income Tax Act. And that section 90 clearly provides, and that has been the reading of the Apex Court also at several occasions, that while governing the taxability of a non-resident, the provisions of the Income Tax Act or the tax treaty, whichever is more beneficial, that would be provided. So if in this given example, the payments are taxable under the Act, but not under the treaty, then it will not be taxable in India, and no obligation would arise on you as a payer for deducting tax and depositing with the government. Whereas if the analysis of tax treaty suggests that yes, it will be taxable, then you have to go to a further complication, that that what rate I should apply. Should I look for a rate provided under the tax treaty, or should I look for the rate provided under the Income Tax Act 1961? And then you have to choose a rate which is more beneficial and accordingly deduct the tax. So that is how this whole scenario would work. Akshay, would you like to add something here?
Yeah, Nitin. So one of the points, as rightly pointed out by Nitin here, I think another aspect which also becomes important for us to see is on the beneficial rates. Just to, highlight with the help of an example, that if your taxability is under both scenarios, that is under the Act as well as the double tax avoidance agreement, then it becomes important for us to see what is the rate which should be used. For example, your India-US treaty would give you a rate generally higher as compared to the rate which is provided under the Act. So you should, as a prudent, someone who's making the foreign remittance, you should always opt for the rate which is prescribed under the Act and not under the treaty. So these are the checks and balances which one needs to carry out when actually making a payment to the non-resident. Yeah, Nitin.
Yeah, thanks, Akshay. Thanks. And one another complication would come, and that we will take you through. It is not uh, automatic that a non-resident will have a treaty benefit. So we'll deal with that situation in the ensuing slides. That before you apply tax treaty, what are the things you must do, and if those are not satisfied, then there could be a situation that the non-resident may not have any tax treaty shelter also. So if there is no shelter, then certainly you know that okay, you are coming back into the Income Tax Act, and then you have to analyze the taxability within Income Tax Act itself. So this is section 195, which governs the provision of tax deduction at source wherever you make payment to a foreign national, and it seeks to provide that that whenever a person making payment to a foreign national, including a foreign company, and that payment is liable to tax in India. And if that is liable to tax in India, then tax has to be deducted at source basis the rates or rates in force provided under the Act. And then this is the 195(1) which is there, and then you have other nuances that should I go as per the rate, or should I have some flexibility? To what extent I will have flexibility? If I don't do, then what are the penal consequences I may face? So these all are attached to section 195. And why foreign remittances and 195 is essential? Because for one reason, that say for example, if you make a payment to a resident, and I believe that you know that when you make a payment to a resident, then there are some provision to deal with tax deduction at source, like contractor and professionals, and then you have to deduct tax under 194C or 194J. If there is a default, at least you are not bothered that you will be asked to pay tax portion also, because you have made payment to a resident. Possibly you have all the information, and then the other person who is the payee, the recipient, must have filed tax return and accordingly must have paid the taxes thereon. So at least you'll not be asked to pay tax, but interest or the other penal consequences. But here, when you are talking about the remittances, foreign remittances, you are dealing with a foreign resident or a foreign national. If foreign national has not filed tax return in India, has not paid tax in India, then you'll be exposed to pay taxes also on behalf of the foreign national. Therefore, it becomes more important to look at 195 very carefully, the chargeability, taxability very carefully. And there is a thumb rule which we always say that when you are as a payer and you are dealing with a situation of making a payment, then don't be aggressive, be conservative. So be conservative means that if you have a doubt, then do not take no withholding position. Then what are the things you have to keep in mind? I and Akshay will take you through. And if still you are not comfortable, then ask the recipient to approach to the tax officer and seek a nil withholding tax certificate. How that will come into the picture, we'll take you through. So that's the thumb rule, that in case of any doubt, be conservative, especially when you are making payment to a foreign national. So this is how section 195 looks like. So 195.1, as I just alluded to, that contains scope and conditions that you are making a payment. If it is chargeable to tax, then apply withholding tax or a tax reduction at source, or as per the rates or rates in force provided under the law. Then 195 subsection 2, that provides flexibility. And I was just saying that in case of any doubt, you as a payer or I as a payer can approach to the assessing officer and with a request to determine that how much of the payment I am making is chargeable to tax in India and what rate I should be applying. So that remedy or that flexibility or liberty is there under section 195.2. We'll take this up a bit detail a little later. 195.3 is also that where the recipient can approach to the officer and seek a nil withholding tax certificate. So what are the difference between 2 and 3? We'll also take you through. 195.4 speaks about validity of certificate, which is the withholding tax certificate issued by the AO. Subsection 5 talks about the power of CBDT, Central Board of Direct Taxes, which governs the tax affairs in India, which sits in the Ministry of Finance, to issue necessary notifications and rules relatable to the application of section 195. Subsection 6 compels the payers to provide information with respect to some classified payments. And subsection 7 empowers CBDT to specify class of person or cases where application to AO is compulsory. So why compulsory? Is there any history? We'll take you through. So this is the structure of 195. Yeah, Akshay.
Yeah, thanks, Nitin. So, as Nitin was just highlighting on the overall scope which is there of 195, 195.1 basically talks about that any person who is necessarily a payer is making payment to a non-resident, and that that payment which is made, which is for the nature of any interest other than certain categories of interest which have been excluded, and on which any sum is chargeable under the act. Now, the term sum chargeable is something on which we will particularly highlight, because that has been something of, where there has been a lot of controversy on what is classified as sum chargeable. Then, irrespective of the amount on which the payment has been made, the payer is obligated to deduct tax at the applicable rates which are there as per the rates in force. Now, interestingly, if you see that there is no mention of any threshold here. So as we have seen for all the domestic transactions, for all our 194CJ, there is a specific threshold which has been prescribed. There is no such specific threshold as far as 195 is concerned. Now, the first issue, and which has been a matter of controversy all along, is whether when we are making reference to a payer, whether a payer would be someone who is a resident, or would it also mean that it would also cover a non-resident. Now, this specific issue has been, considered by the Supreme Court in Vodafone, that wherein they had classified, or wherein they had concluded that a payer in such case of 195 should only be restricted to a resident and would not include within its purview a non-resident. But as in many cases, we would have seen that the government usually comes up with clarifications, retrospective clarifications. In this case also, they came about and they clarified by way of an explanation that for understanding of 195, the the intent was always to include a non-resident also in its purview, irrespective of whether it has a place of business or not. Now, what this essentially implies is that if suppose a US resident today is making payment to a UK resident for any activity which is carried out in India, in terms of any contract which is undertaken, then essentially, if we strictly read 195 as of today, there would be an obligation for them to deduct tax as per section 195. Next, the reference I was making to in the previous slide of any sum chargeable to tax. Now, this has been somewhat of a continuous debate and an issue on what would be classify any sum chargeable to tax. As if we read 195, it says any sum which has been paid by the person to the non-resident. It only talks about payment which is being there. So the question is that if today I am making a payment of rupees 100, and if that payment of rupees 100 has no component of any income chargeable to it, whether there would be any application or any obligation under me to actually deduct any tax. Now, as Nitin in the previous slides had made reference to section 4 and section 5. Section 4, he spoke about wherein we talk about the total income which is there, and section 4.2, which talks about the recoverability. It has been laid out very clearly that if at all there is any withholding which is to be undertaken, it is only to be undertaken wherein there is an obligation or wherein you have any income component to it. If essentially the payment which you are making does not have any income element to it, then it would fall outside the TDS purview. Then it would fall outside the withholding tax purview, and there would not be any obligation on you. Nitin, will you like to add something here?
I think it's quite clear that for foreign remittances, just reiterating what we said earlier, and then now Akshay has also explained, the taxability and tax deduction at source obligation go hand in hand. So if there is no taxability under the law, and law means Income Tax Act 1961, as well as the tax treaty, then you and I as a pair should not have any obligation to deduct tax and deposit with the government. Yeah, Akshay.
Sure, Nitin. Now, moving on from that aspect on, on the payment, and when I make the payment, what is the element on which the tax needs to be deducted? This issue again has been a matter of a continuous debate, and it was somewhat clarified by the Supreme Court in the case of G, wherein they had clearly brought about that you as a payer are only bound to deduct tax if there is any income element in any payment. So if today I make a payment of, taking the same example of making a payment of rupees 100, and that has two components to it. One, a rupee 10, which is taxable according to me as a payer, and rupee 90, which is not taxable, then I am only obligated to deduct tax on that 90 rupees. And there would not be any obligation on me to deduct tax on that 10 rupees. I may still believe that 90, even though I'm making the entire payment of 100, there is only obligation to deduct tax at 10 rupees and not on the entire 100 rupees. So this is what even the Supreme Court had laid down and clarified by way of its judgment, that there is only obligation to deduct tax on the income element per se and not on the composite payment. Now, next, the controversy which Nitin was talking about on what are the rates which are to be, on which the tax is to be deducted, and what would be the rate as a payer which I have to adopt while withholding taxes. So, as a prudent businessman, I have to only deduct tax on the lower of the rate, which is there as per the rates in force, or the specified rate which has been provided under the treaty. Now, generally, under the treaty, the rate which is there is a gross rate. And what we mean by a gross rate is that if I go through the any treaty which is there, generally under Article 2 of the treaty, wherein the term taxes is defined, it generally is worded in a manner that the taxes shall include income tax and including any additional surcharge thereon, which means that it is somewhat of an inclusive payment which is made. So I when I make a payment to a non-resident in case of any income which is chargeable to tax, then I shall make the payment of the rate which is either under the act or the treaty. The rate under the treaty is inclusive of surcharge and cess. So, for example, if I make a payment of 100 rupees, the rate which is there under the domestic tax is generally 10% plus surcharge and cess, which roughly comes up approximately to around 10.5, 10.6. Whereas the rate which is there under the treaty, if it is 10%, that 10% is the inclusive rate of surcharge. And this has also been confirmed by various judicial precedents over time.
So Akshay,
Yeah.
if I may add something on previous two slides.
Mhm.
So like we discussed that as a payer dealing with the foreign remittance, and we need to be extra careful and conservative. And just like Akshay mentioned that the Supreme Court in G India, and there are other judicial precedents also where they said that while you are applying Section 195, you need to confine yourself on the portion of income which is taxable in India. But there are some disputes because the tax department believes that 195(2) would come into the picture, meaning thereby that you have to go to the tax officer with a request to determine the appropriate portion on which tax is required to be deducted. In case the whole of the sum is not chargeable to tax. So meaning thereby that the example given by Akshay, one school of thought is that if I'm making a payment of rupees 100, and in that 100 rupees, 90 is not chargeable to tax. This is my analysis, but 10 is chargeable to tax. Then relying upon the judicial precedent, I may apply tax on the taxable portion, which is 10. Whereas there is another school of thought which says that in order to remain on a conservative pedestal and on a safer side, keeping in mind the scope of Section 195(2), it is prudent and it is better to either you as a payer, go to the officer and say that this whole sum is not chargeable to tax, and therefore I need to apply tax on this taxable portion, which is 10. Kindly confirm my understanding and give me a tax rate. So these are the two aspect what we have seen. But if the arrangement is so that the payer has to bear the Indian taxes, meaning thereby that if your arrangement or payment contract is worded in a manner that in case any Indian withholding tax comes into the picture, then that has to be borne by you as a resident. Then you will have to see that should I really go with the officer and for applying a withholding tax certificate, or I can safely rely upon, say, Supreme Court in G India, and then there are other decisions to follow, and can safely make an ascertainment about the portion which is taxable in India and apply tax only on that portion. So that's a calculated risk, and that's a calculated call has to be taken by the payer. but I would recommend that as a person, either you are advising your client or you are sitting in a corporate and dealing with the tax matters there, or you are, say, educating others also. Then, as a payer, where tax instance is to be charged or to be taken up by the recipient dealing with foreign remittances, then we must remain on a conservative side. So that was one, and that's the beauty of dealing with
Sorry, my
technology.
apologies. Sorry.
No worries, no worries. No worries. So that was one aspect. Second, on the treaty rate and including cess or surcharge or not. So maybe you can have this thumb rule, because now there are many decisions to support that proposition that treaty rates do not have education cess and surcharge. So if you are end up having the analysis that yes, transaction is taxable in India, and choosing the rate out between Income Tax Act and the tax treaty, and if you are taking up a treaty rate, then you can safely have only the treaty rate without taking up education cess and surcharge. And there are sufficient judicial precedent available to support that proposition. Yes, Sanjay. Yes, sorry, Akshay, over to you.
Yeah. So thanks, Nitin. So essentially, Nitin, has just brought about a few of the points on 195.2, which is essentially the lower withholding certificate. And moving on from there, there is, we just also wanted to bring to your attention a particular section 206AA. Now, essentially, it came as a section which overrided everything else which was contained under, the specific TDS chapter, and provided that irrespective of whatever the rate which is prescribed under the Act or the DTA, both of them would not apply, and only the rate of 20% would apply, provided it is the highest available rate. And in a practical sense, it was the highest applicable rate for more than several occasions. Now, why this was introduced essentially was that they wanted to curb the practice wherein the foreign entity did not have any permanent account number in India. So what they wanted, that every transaction which is conducted with a non-resident and they do not take a permanent account number in India, and only by way of deducting, where the payer deduct tax at 10% and he offers it on a receipt basis and offers his is deducted at 10%, and he does not offer or file any return of income in India, they wanted to do away with this practice. So they brought about this rate of 20%, which provided that irrespective of the rate which is provided under the Act or the treaty, the highest available rate would be available. Over time, there was a lot of pushback from various sectors, wherein they pushed back on this, really high rate which was imposed by the government. So they, did away with this specific requirement of PAN, and they then introduced what was essentially somewhat of a basic documentation which is required, which means that wherein the non-resident, as a as a person who's receiving income from India, wherein he is able to provide certain justified documents such as his tax identification number in his home country, the period for which the income has been earned, and general other basic details, then in that case, the rigors of 206AA were done away with. And there was only and if the recipient is able to offer these documents, then he would be taxable, or he can offer taxes at the reduced rate of 10% or whatever rate is, a reduced rate. This is a very interesting issue which was there under the domestic tax, and it has been there for long, on whether only a payment which is made by way of any actual money transaction being undertaken, whether withholding tax would be applicable only on those transactions, or would it also cover any transaction which are beyond that? So what it essentially means that if today I am entering into a transaction with a foreign customer, a non-resident, and if I tell him that instead of making you actual payment of USD $100, I would, for instance, do some other service activity for you, would that mean that there would not be any withholding tax obligation at my end? So this was particularly, has been dealt with several rulings, and they have clarified that Section 195 essentially covers by any other mode. So the legislature, considering the overall, complications or the overall issues which may have arisen due to this limitation, they had essentially brought about this particular phrase by any other mode, which means that if I am today providing a service, irrespective of the manner in which the transaction is undertaken, that is whether by way of money or not, there would be a withholding tax obligation at my end. And for this, maybe the best possible recourse would be the fair market value of that particular transaction. Nitin, you want to add something here?
No, I think we are clear.
Okay. So this portion I have touched upon. I think we are a little slow on our time, so I'll just probably try to see what all can be pushed a little. Yes. So this was the issue which has already been taken by Nitin, and he already highlighted on this. Now, one issue which generally comes is that if you are making an application under Section 195(2), and essentially everywhere it is said that there is a belief that there is some income which is chargeable to tax. So essentially, when a payer is actually making that application, is he actually making it for determining that portion of income, or is it there for determining on whether a nil order can be issued or not? So this has been a area of concern, but practically we have seen that the payers also approach the authorities for nil withholding certificate orders also. Though you may not get that order from the AO on a practical standpoint, but still as an applicant, you do approach the authorities for nil withholding orders also. Another aspect is that there is no time limit which has been prescribed as far as your disposal of applications are concerned. But, by way of the government citizens charter, they have very well clarified that they would want that all applications are disposed of within a period of 1 month. And here we would also, I think Nitin would also agree here, that the department has been really proactive when it now comes to disposing of any of the applications which are there. And generally we used to get stuck up with these applications for long, but now it's a very expeditious movement which is taken off all the pending applications which are there. So I think we have already dealt with this, and Nitin took it some time back, so I'll move on this. Next is on the validity of the certificate, and till when can the certificate be valid. Now, generally, Section 195(4) covers the validity of certificate, and it generally remains in force until the period which is specified, or if it is cancelled by the assessing officer for some reason which may be there. So until then, your certificate is valid, and you can apply that certificate for making payment to foreign vendors. This is basically that the CBDT under 195(5) has been given certain powers that it may come up with certain rules, clarifications on any matter which has been a part of litigation, maybe, or any specific rules with regard to how the applications are to be processed, etc. What is the timeline? So for this, this has been prescribed. 195.6, which is specifically for Form 15 CSCB, we would be dealing with this specifically separately. So this would be covered. 195.7, by way of Finance Act 2012, the CBDT had come up with certain clarification that there would be certain classes of taxpayers which would be determined by the government, but there is no formal notification yet on this aspect. So this is, as of now, it is not relevant for us. This is 195A, or glossing up. So as Nitin was alluding to the fact that you have to be mindful on when to approach the officer, and he brought about this issue that you may not want to approach the officer whereas the cost is on you. So what it means is that if today my foreign party or my foreign vendor from whom I've taken services, for instance, says that irrespective of whatever obligations are there in your domestic law, I should receive the payment of 100 net, then it essentially means that the agreement or the terms of arrangement which you have with your vendor is on a net of tax basis, which means that you today have the obligation of deducting tax when you make the payment to him and make him the net payment of 100. So this is just a small example on how the numbers would flow. So if he says that I should receive essentially 100 rupees, the taxable or the tax rate is 10%. So what it essentially means is that income in the hands of the non-resident would be 111.11, which is basically A divided, which is 100 divided by 90. The tax on it would be around 11. So the TDS obligation which today I have is 11.11 instead of 10, which means an increased cost in my hand. So this is basically 195A.
So Akshay, before we go ahead, and I would suggest that maybe let's take a step back and summarize that what we have discussed over here. So we discussed that as a payer, resident of India, making payment to a foreign national, uh, we I have to see that whether the payment is taxable in India under the provisions of the Income Tax Act, and then I have to see that if that is taxable, is there any tax treaty available to the foreign national, and is that payment taxable under the tax treaty as well? If the answer to the analysis is that payment is not taxable, I do not have any obligation to be discharged. If the payment is taxable, then I need to see that which rate is beneficial, whether under the Income Tax Act 1961 or the tax treaty. And also, am I really certain about it that the whole of the payment is taxable in India? If the whole of the payment is not taxable in India, some portion is taxable in India, do I have flexibility to determine that, or I have to go necessarily to the tax officer for seeking a withholding tax certificate? Say out of 100, it's only 80 or say 20 is taxable. Kindly apply tax rate on that 20 and give me a certificate, which I will use to protect myself so that tomorrow penal consequences should not be triggered against me. So you may take a note that if you have a 195.2 certificate saying that out of 100 rupees payment, you apply 5% tax rate, and tomorrow the payments are being seen in the tax assessment of the foreign company and found to be taxable at a higher rate, say 10%. No penal consequences could trigger on you because you will be protected, as you already had 195.2 certificate issued by the tax officer. So those certificate will really protect you from the penal consequences. And then if payments are made in kind or those are monetary payments, makes no difference. 195 would come into the picture. That's what we discussed. If the arrangement is so that you as a payer have to bear the Indian taxes, then that means it is a net of tax arrangement. And in net of tax arrangement, 195A comes into the picture. And while discharging the withholding tax, you have to gross up the amount. The objective of grossing up is that in the given example where you have to pay net 100 to the foreign company, whereas the tax rate is 10. So essentially law envisages that the amount of tax you as a payer is bearing in India, that is also an income in the hands of the foreign company or a foreign national. So here the income is 100 plus the tax is borne by you. So how you would factor that tax also while discharging the TDS provisions? So you have to factor that 100 plus tax, and then you have to apply the rate. And then if you keep on applying, then there will be an iteration. So therefore, there is a method to apply a grossing up, so that you end up having a result like 111.11. You apply 10%, 11.11, and then the balance 100 is paid and 11.11 is paid to the government. That's the grossing up is all about. We also discussed that when you choose rate between treaty and act, in the treaty rates, you do not add education cess and surcharge. And the last point, as an advisor, or maybe you are advising your client, or you're sitting in a corporate where your group company, or say your clients, other group companies, two foreign nationals are dealing with each other, where the transaction is found to be taxable in India, then certainly this 195 would come into the picture, even though both the parties are non-resident and they do not have any presence in India. So this is what we all discussed so far. And another thumb rule that being a payer, remain on a conservative side. If you have to bear the taxes, then after seeking professional advice or doing your due diligence, then take a call that, okay, should I be relying upon judicial precedent, or should I play on a safer side and approach to the officer and seek a withholding certificate? So this is the sum and substance of 195.1. Some mechanical aspects, some procedural aspects would come into the picture. The another aspect, what we discussed earlier about choosing tax, choosing act or tax treaty. These are a couple of points which you must keep in mind before applying the treaty benefit to the foreign national. And we'll broadly touch base these aspects because these are subject in their own. There are again many dimensions to each point over here, but broadly, it's not sacrosanct that all the foreign nationals are entitled to treaty protection or a treaty benefit. You have to do some labor, you have to do some due diligence before extending the treaty shelter to the foreign national. So the concepts like principal purpose test, beneficial ownership, tax residency certificate, and then certain conditions which are embedded in the tax treaties like limitation of benefit or say anti-abuse provisions. These are quite essential and to be seen, to be analyzed before you extend the benefit of tax treaty to the foreign national. Yeah, Akshay.
Yeah, thanks, Nitin. So, as Nitin rightly alluded to, that you cannot just provide a treaty benefit to the foreign national, and there are certain checks and balances which you today as a payer need to carry out. So I would, just start with the first one, which is tax residency certificate. Now, as a payer, when you make the payment to a non-resident, the first and foremost essential criteria is that the payment to whom you are making, whether he's a resident of that country, and that becomes the foremost criteria to to determine on whether the eligibility of the the treaty benefit can be given to him or not. Tax residency certificate, and whether in itself it establishes sufficient proof for it to be a resident of a country, has been a matter of debate. We would just touch upon that separately, but essentially TRC is considered as a sufficient evidence in itself for a person to be granted the status. Government over time has started introducing certain additional checks and balances to make sure that these essential requirements are present in the treaty are present in the TRC for it to grant it the treaty benefit, which have been laid down specifically under section 95, which is whether it is the status of the assessee, whether it is individual, company, firm, its nationality, the unique identification number which it has in the home country, period for which we are taking TRC. So TRC is not something which can be given to you for an indefinite period. It has a shelter or a shell life to it. That is another aspect. And then where it is incorporated in the country of residence, where it is the address. For Indian residents, you can also today take TRC. So, in a reverse scenario wherein some payment has to be made by a NR to a resident, there also there is a requirement of TRC, and then obviously you can approach the tax authorities for that.
So, so friends, what we are discussing over here is that now you are moving to the treaty domain. If your analysis suggests that payment is not taxable under the Income Tax Act itself, there is no requirement to move into the treaty domain and see that whether there is a TRC or other conditions are satisfied or not. You will move only to the tax treaty when you will find that the payment is taxable under the Income Tax Act, and then you are seeking or you are applying the treaty shelter to the payments. And the first point is that the tax residency certificate, which is issued by the tax authorities of the home country of the foreign national, and then it needs to be kept in your record and to be provided later on to put forth that the recipient is actually entitled to the treaty benefit. And if TRC contains these information like status of the assessee, nationality, etc., then actually I'm right that that this form 10F is not required. It's only required if TRC does not contain these information, right? Okay.
Absolutely, yeah.
So this is the principal document. One, you must obtain TRC or form 10F, as the case may be, should you choose to apply treaty benefit to the recipient. Yeah, Akshay.
Thanks, Nitin. Next is on beneficial ownership. Now, essentially, if I see that beneficial owner is a term which has been used time and again, and we would have also heard on various occasions that the benefit of the treaty per se can only be given to someone who is a beneficial owner. Now, why essentially all this came into the picture, and why is this such a big controversy is, and I'll just give this by way of an example, by way of a example of a Mauritius entity. Now, in the past, we would have seen that Mauritius was introduced as an investment haven from which a lot of investments were coming down to India. So there was a period when we liberalized in terms of our economy. There was a lot of FDI which started coming in, specifically from Mauritius. And even if we see the intent with which the treaty was entered, the intent was that we wanted to attract foreign investment from Mauritius into India. And this, as we see that, it became a regular practice for all the foreign residents to actually form a structure wherein they would have, for instance, a US parent, they would have a subsidiary based out of Mauritius, and then it was India. Now, the question arose that essentially, who can be a beneficial owner? A beneficial owner can be someone who is actually entitled to the risk, the benefit of whatever is coming into its way. So, if today the Indian business was to go bankrupt for any reason, ideally, if Mauritius entity was the shareholder or the principal person who is a beneficial owner, he should be impacted by it. But if that is not the case, and if it is the US parent who is impacted, then somewhere we can move toward the fact or align ourselves to the fact that maybe the Mauritius entity is not the beneficial owner. Now, this aspect was considered in a very famous ruling of, Universal International, wherein they had concluded somewhere that TRC as a document would be sufficient for you to constitute that he is the beneficial owner. So if today the Mauritius resident is able to provide the tax residency certificate, then it would be sufficient for it to conclude that yes, he is the beneficial owner of that, of there is the benefit whatever come to it from the Indian entity. But still a lot has passed since this last ruling, and still this is a very grave area on what would be a beneficial owner and who would be a beneficial owner. And this term, the term beneficial owner, is actually used in a lot of treaties with respect to your fee for technical services, royalty, dividend, interest, wherein they have time and again used this term that he should be the beneficial owner of the payment, or he should be beneficially owning the payment, whatever is coming to him. Nitin, you want to add something here?
Yeah, just one thing that this term has not been defined in the income tax law, but there is a quite a good commentary available from the foreign jurisprudence, and now we have some Indian jurisprudence also available. Why we are compelling the payer to look at the beneficial ownership? The simple reason is that this term and the subsequent terms are anti-tax avoidance measures, have been provided under the tax treaties to ensure that there are no malpractices, or there are no practices like treaty shopping is happening, where the recipient, who is merely a conduit, is set up or is placed to take the benefit of treaty, but effectively it is not the beneficial owner. So these kind of safeguards are already provided under the tax treaties, and therefore, as a payer, to what extent onus lies on me to decide on whether the recipient is meeting the beneficial ownership criteria or the other criteria which are coming in next two slides. The burden on me is one that is pretty high, because tomorrow I can be compelled to face the consequences like interest, penalties, etc. But then I have very limited bandwidth to go through this whole and analyze these whole concepts, and therefore the in today's scenario it is recommended to have certain set of documents from the recipients to remain on a safer side. And it is very difficult for a payer to really analyze these concepts while doing a, say, one or the isolated transaction with a foreign national, that okay, I'll make you payment later on, but you provide me all this information to help me analyze all these concepts. So it's very difficult. But these are the points you must have in your mind before you apply treaty benefit to the recipient. You must have some documents in your custody or in your files to show that you have done some due diligence as to that whether these conditions are being fulfilled by the recipient, and therefore you are now applying treaty shelter or a treaty concession to the recipient. Yeah, Akshay.
Yeah. So another, this specific limitation of benefit clause again is anti-abuse measure, which has been specifically incorporated under the treaty. For instance, if we just go through the India-UAE treaty, it very specifically provides that the UAE resident would not be entitled to the treaty benefit if the main purpose or one of the main purpose of creation of the entity was only to obtain benefit of the treaty. So if we just closely look at the language, the main purpose or one of the main purpose is somewhat similar to, as we have in our domestic GAR, which also provides that if the main purpose was to obtain a tax benefit, then you would not be entitled to treaty benefit. Similar to UAE, we have several other treaties like the Fiji Treaty, Poland, Singapore, wherein either by way of certain language or by way of having somewhat of an expenditure threshold that they determine on whether the treaty benefit can be given to a country or not. So, for example, the India-Singapore treaty, which is there, it provides that if the annual expenditure is exceeding, I think it's $2 lakh in the previous 2 financial years, only then you would be entitled to the treaty benefit. So there you have certain checks and balances which the respective governments at the time of entering into the treaties, they realized and they have specifically incorporated that in the treaty itself. Uh, this is the introduction of MLI. So you would have seen that in the previous slide, we had made reference to the principal purpose test. Now, MLI in itself is a very detailed study which is being undertaken by, the OECD BEPS in a BEPS action plan together. The key area which would have an impact, what we believe as tax professionals, which would have an impact both when we are acting as a payer as well as when we are the recipient, is on the principal purpose test. Now, essentially, what principal purpose test lays out is it provides that the treaty benefit would not be granted to the recipient if one of the principal purposes why it had entered into the transaction was to obtain the treaty benefit. Now, the overall intent by which the principal purpose test has been introduced was that there was a lot of realization, and we would have read a lot about the news around Apple, Google, that there has been, they're making billions of profits, but they end up paying very less taxes. So there was a realization, amongst the G20 countries that it is very important for us to actually tax the profits wherever it is arising, and wherever the corporates by way of artificial structures or not so substantive structures are taking benefits of certain treaties, it is important for us, it is important for us to actually curb those practices. So as part of that action plan, they came up with the specific action plan 7, which specifically provides for denying a treaty benefit wherever the overall intent of wherever the principal purpose of entering such a transaction was to enjoy the treaty benefit. Surprisingly, the way it has been written, the way the law is currently, it is actually wider in scope as compared to the Indian GAR also. So this is, one of the key areas as a payer where we have to be mindful. Maybe as Nitin rightly pointed out, that we cannot undertake a detailed study for the foreign vendor, but maybe, we should have or advise clients to have robust documentation in terms of a cover letter or indemnity letter, which should be in place to protect our interest whenever we are making such foreign remittances to any vendor. So we should be cognizant of this whenever we are advising to any payer, because this is already effective. Nitin, you like to add something here?
Yeah, so look at these concepts on a macro level. As a payer, now you are seeking say treaty concession or a benefit. You are providing that to the payer, to the recipient. First, you will have to ask that okay, so see a given condition that you are making payment for a technical services, and those services are taxable under the Income Tax Act, but under the tax treaty of the country from where that recipient is coming is not taxable. Then before choosing a position that there is no TDS liability under 195, you must have TRC in your custody. Then see that whether TRC and 10F are speaking in same manner. Otherwise, you should have 10F also. Then you should see that whether the recipient is a beneficial owner of that payment. And then these other two concepts, that what are the conditions provided under the tax treaty for which are anti-avoidance in measure, including whether this country from where the recipient is coming has really subscribed to MLI instrument, and this principal purpose test has become part of the treaty or not. So broadly, if I look at that, these are the points I should keep in mind and have the documentation in place, so that I should remain on a safer curve, rather than tomorrow I'm exposed to penal consequences. Yeah, Akshay, we can move.
Yeah, thanks. Anjali
Some
ji, just wanted to check in terms of timing, how much flexibility would we have?
Sir, the session is till 12.
Okay, so Nitin,
so I
what do
think
you
Akshay,
suggest?
yeah, I think maybe 10 minutes we can spend on the slides, and then we can leave the session for question and answer.
Okay, sure.
Okay, sir.
Sure. Next, if we just to broadly see on the three categories of payments which we've just highlighted here, is on fee for technical service, royalty, dividend. Reason why we've just taken these three is essentially that these are the most common forms of payment which are actually paid by a payer. So we've just tried to, by way of a chart, just tried to analyze it and see how would the taxability be. I'll, for the timing, in the interest of time, just exclude government and resident. In terms of a non-resident, essentially what is important is that whenever you analyze any transaction, is on you have to see on whether is it in respect of any services which is utilized by a person in India. That is one. If the answer to that is yes, then it can be taxable. If the answer to this is no, then it would not be taxable. Of course, it would be taxable subject to if it meets the if it falls under the specific definition which is bearing under the fee for technical service and the respective clause. Again, on is it for the purpose of making or earning income from any source in India? Now, source, derived, utilized, they are concepts which have, moved on, evolved over a period of time. Still, there is a lot of litigation, lot of deliberation which happens on it. But if it is from any source which is from for earning income from India, then yes, it would be taxable. Otherwise, it would not be. Now, for as far as taxability of FTS royalty is concerned, and here we have only captured the scenario of a non-resident. There can be two baskets to it. One is where the permanent establishment does not exist. Then we have two umbrellas there. One is under the Act, and there you can be taxable on a gross basis. There you can be taxable on a gross basis, including surcharge and cess. And else, there can also be a scenario wherein you're taxable on a net basis, and which would be essentially 40 plus relevant surcharge and cess. Under the treaty, as Nitin already highlighted, that there would be gross basis taxation if you do not have any P, and there, depending upon the relevant rate which is under the treaty or the act, you can be taxable at 10, 15, or 20. Second scenario is that if there's a specific P which exists, then you would be taxable under the Act. There's a specific section 44DA which has been prescribed for it, on which you would be taxable at net basis. And if there is a P and you have the relevant treaty benefit available to you, there you would be taxable, at in accordance with Article 7, which is business profit, and whatever income you have earned would be offered on a net basis. Here, without going into too much detail, what we have essentially done is we have just modeled, the respective definition of fee for technical services as is provided under the Act versus the treaty. Essentially, under the Act, it provides that any service which is of a managerial, technical, consultancy nature, with certain set of exclusions, would be something on which FTS would be applicable. And the services which we offer is today a consultancy services. Similarly, if a non-resident is performing such services, it would essentially be taxable under fee for technical services. Then moving on, we also have similar sort of definition under the treaty, but there are certain treaties wherein you have a restrictive scope with regard to taxability, which essentially what we call as make available. Now, the interesting issue which comes with regard to make available is, now make available typically talks about, and I'll just quickly take it, that if suppose I am rendering certain technical services or consultancy services, example, I am a chartered accountant, I provide taxation consultancy to various clients. Now, as long as I am providing this service to you, but the other person who is the recipient is not able to use this service on his own in the future, then you can say easily that the make available condition is not fulfilled. So for example, if today I am a non-resident, I provide services to a domestic person, helping him for a certain technical project, assuming that it is a technical service, but that resident would again tomorrow would have to come back to me to avail that service again, then it can be said that the make available condition is not fulfilled. This, as various other topics, along with various other topics, are actually a subject on their own. And so, pardon me for taking, through this so quickly. Second is on the royalty. So this is a model definition of section, of royalty, which essentially provides that, for transfer of all or any right in respect of any patent, invention, model, or the use of imparting any technical, industrial, commercial experience, use or right to use, transfer of copyright, uh, software, etc. This is something which would essentially come under the definition of royalty under the Act itself. The definition under the treaty is a bit more narrow, and you have the benefits which are available under the treaty as compared to the Act. So that is there. Nitin, I'm thinking I'll just move on to the remittances part, 15th CB.
Yeah. Because just because we are giving a little high
Yeah,
uh,
it's a
very high level overview of these transactions. Otherwise, there are many nuances to it. And just for the sake of comparison, that while you analyze, say taxability of interest, royalty, technical services, there are specific provision under the Income Tax Act 1961 under Section 9. And then there are comparative articles we have under the tax treaties. So you have to make a comparison between the two, that which is more narrower and which is more concessional or beneficial to the recipient. And then accordingly, you have to analyze the taxability. And that's a very cumbersome task. A lot of jurisprudence and judicial precedents available for in favor and against the propositions. So we thought that in order to give you a broad overview that what are the typical stream of income, and that's what it is. Maybe you are right, Akshay. We can move to the specific procedural aspect of foreign remittances.
Yeah. So as we had discussed, under 195, there is a specific section, subsection 6, which provides that when you make a payment to the non-resident, there is an onus on the payer to fill up certain forms, and if that transaction is, also on the chartered accountant as a chartered accountant to fill up form. So there is a form 15 CA and CB. 15 CA is an obligation on the, it's a form which has to be verified by the payee. And then you have a 15 CB, which is a form which is to be given by the chartered accountant. Now, essentially, 15 CA talks about that it has to be remitted by the taxpayer for any remittances which are made to the non-resident. Now, it has to be filed in every case, irrespective of whether the amount is chargeable to tax or not, except there are certain, certain transactions which have been excluded from that purview. Only in those cases the obligation goes away. Otherwise, there is a reporting obligation of Form 15 CA in every case. Next is 15 CB. 15 CB is something which is only to be given only in a case of a taxable transaction and not otherwise. 15, so if I have to bucket the two, 15 CA has to be done mandatorily in every case except for few cases which have been excluded. And 15 CB is only to be given only in case of a taxable transaction. Here, by way of a chart, we have just tried to simplify and tried to bring about how it is to be done. So if you have to make any remittance during the financial year, and if it is not chargeable to tax, then yes, there is a reporting obligation. Then yes, it is a there is a reportable transaction, and you have to report that transaction as per Form 15 CA Part D. If, however, it is chargeable to tax, then there are three buckets to it. If the amount is greater than 5 lakhs, then if you either go by way of a AO order, if you report if you take your application under 195(2)(3), as we had discussed, then you would be reporting your transaction in Part B, which is 15 CA Part B. If you do not take your application to the AO, then you would be reporting your transaction under Form 15 CA Part 15 CB and Form 15 CA Part C. I'll just summarize it. If your transaction is chargeable to tax and it does not come under any of the restricted transactions, then there is an obligation on you to do a Form 15 CA compliance under Part D. If it is chargeable to tax, there are two buckets to it. One, if it is greater than 5 lakhs, then if you have approached the AO, you would be filling up Form 15 CA Part B. If you have not approached the AO, then you would be filling 15 CA Part C along with Form 15 CB. If, however, your transaction amount is less than 5 lakh rupees, then you are only required to fill in Form 15CA Part A. Nitin, I think we can skip this. We can take the penalties.
Yeah. So I think now we fairly understood that uh, the TDS obligation on the payer, which is a vicarious liability, to ensure that if the transaction is taxable, taxes have been deducted and paid with the government before the amount is either credited to the account of the payer or payment is made, whichever is earlier. These are the following consequences for the payer if there is a default in complying with the TDS provisions. Uh, First and the foremost is that recovery of tax, which is not stated here, but that is a natural consequence that in case the recipient has not paid the taxes in India or has not filed a tax return in India, then the recovery of tax may happen from the payer, and thereafter the consequences like denial of deduction as per section 40AI. 40A3 talks about or takes into consideration payments of salary to foreign nationals. Then mandatory interest under section 201. And then the levies like 234E for TDS return, and then the penalty under section 221. Though there are some deliberation and some judicial precedent that penalty under section 221 and the next slide capital 271 capital C should not come simultaneously. One of them should apply. But these are the broad consequences. One, the payer has to face in case there is a default at his or her end while not discharging the TDS obligations. And the last one is the prosecution, that if you really deduct tax but you do not deposit on time, then there is a exposure of prosecution being launched because of that default is also there. And typically we have seen that that happens when you relate back the transaction, say at the time of books are to be closed. And we have seen that those practices sometimes gives a flavor that the taxes were deducted on 31st March but deposited say in September, and there is a delay of say 6-7 months, and those are the cases where prosecution notices have been issued. So you need to be very careful while recording the transactions in your books of account. uh, you can always live with the exposure of say penalties etc, because these penalties are subject to reasonable cause, which is section 273B, that I have a reasonable cause, therefore I did not deduct, and so on. But for prosecution, it is difficult, and you will have to go for compounding, or you will have to face the consequences. So recording transactions in your books should not give a flavor that you deducted at X point in time and deposited with a gap of say some time, and therefore you are exposed to the prosecution. Akshay, anything you want to add here?
Yeah, just to add, and Nitin, I think, has summarized well that the rigors of actually deducting tax and not giving it to the government, even when we actually look at the interest component, also there also a higher levy has been imposed. So the government is very, very conscious of the fact on its TDS collections, and there are practically, I can tell you that at the quarter ends, you would get numerous calls from the officers on what is the TDS amount which you are depositing, and they would issue notices if they find on a practical level that there are shortfall as compared to what you were doing in the previous quarter, because TDS itself comes as a huge collection source for the government. So TDS compliance, as we as corporate generally advise a lot to our company, that you should do a very strict compliance of all the TDS compliances which are there. I think this is it, Nitin. So we can probably now take the questions.
So, so this whole subject is that why what due diligence I have to cover at my end to remain on a safer curve. What sort of documentation I should have, what other strategies or assessment or analysis I have to do as far as to determine the taxability of the transactions, and I should have the consequences uh, of default in case I take any aggressive position or I default on complying with the provision. So this is the whole paradigm of dealing with foreign remittances. Of course, there could be some other dimensions also, but the points which we thought that are material and to be kept in mind, we captured over here in the presentation. If you have any point or which is not captured here and you need any clarification, maybe you can write to us through Dr. Anjali separately, and we'll try to give our views or we'll try to address your query uh, over email as well. So I think now we can take up the questions we have, and we'll try to give answers if those are not already given here.
So, would you like me to take up the questions?
Yeah, sure, please.
Okay,
That will be helpful.
the very first question is of Sachin Goyal, sir. He's asking what is the taxability of salary paid by Indian company to its employees posted outside India?
So in case of employee posted outside India, let's look at first of all section 6 for those employees, whether they are resident of India, they are resident but not ordinary resident, or they have become non-resident. So the taxability would depend upon the residency of those employees. If they have become if they have become non-resident, then the employment exercised outside India should not result into any taxation in India. If they are purely resident in India, then of course their global income is liable to tax in India. And being an employer, 190 section 192 would come into the picture. And for resident, not ordinary resident also, the foreign source income would not be taxable in India, but Indian source income would be taxable in India. So essentially, it would depend upon their residential status, and then accordingly, the taxability would be derived, and the TDS obligation on the employer, if it is still an employer, would come into the picture.
Okay, sir, thank you. The next question is of Sunil Agrawal, sir. He is asking, in COVID period, many non-resident Indians are working from home. Example, Google USA allowed work from home to its staff till March 2021. If any non-resident is working since November 20 and salary are also transferred in the saving bank accounts in USA, how this will be addressed in taxation?
So I'm assuming that you're speaking about a non-resident who is stuck in India and working from India during this COVID period. And if that is the situation, then we do not have any exemption being granted under the income tax law so far to deal with those situations. So the taxability would remain like you have to see section 6, the residential status of the person, and then you have to apply the TDS obligations likewise. So if the person has become a resident, of course it is taxable. If non-resident, even on that basis, because employment shall be exercised in India as per the income tax law, as per the relevant tax treaty, uh, the salary income for that period should become taxable in India. Akshay, would you have to add anything here? All right. Okay, we can move to next one then.
The next question is of Mr. AJ. Please write your full names. In a composite consideration having element of both taxable and non-taxable, how does one judge which amount to be subject to TDS? Answer in continuation with this, he's also asking, so for composite consideration, only option left is to approach AO.
So there is no set rule that in case of a composite payment, you have to necessarily go to the tax officer. So the law says that in case the whole sum is not chargeable to tax, who is empowered to determine the sum which is chargeable to tax and accordingly rate as per 195(2) is the officer, or you can ask the recipient to go to the officer under 197, because payer can go to officer under 195(2) and payee recipient can go to the officer under 197 to determine the tax rate. That is the due diligence or strategy I recommend to be adopted by the payer on a conservative basis. But yes, in case the tax is to be borne by you means you are a payer, and then there are time limitations, then one can see that to what extent you are certain about the taxability of the portion. Say for example, capital gains. If you have with you the cost of acquisition, if you are able to calculate the chargeable capital gains, then you can take a position that yes, there is nothing which I would need help from the officer, and therefore I can apply the withholding tax rate only on the capital gains portion rather than on the whole consideration. And that is when you are taking the brunt of Indian taxes. But again, if the tax is to be borne by the recipient, I always recommend that the payer that okay, you should not apply your judgment, but to approach to the officer.
Thank you, sir. The next question is of CA Vaibhav Kedia. He's asking, the holding company pays the IT fees to Oracle Inc. under its master agreement for all its subsidiaries, including Indian subsidiary. Indian subsidiary reimburses the same amount which has been charged by Oracle Inc. to its holding company. Whether this transaction is subject to WHT, as there is no income element to the holding company in this case. What should be the nature of payment and RBI purpose code in such case? Is the remitter is allowed to decide whether there is an income element in payment?
Okay, so there are two aspects. One is the taxability, and then the classification. So I'll deal with the taxability. See, when it comes to the taxability of reimbursement, and generally we have seen the argument is taken that it is a cost to cost reimbursement. There is no income element embedded therein, and therefore it should not be chargeable to tax in India. But I think from a legal interpretation side of it, and from a reasonable standpoint of it, if that argument is to be taken, then you can see that many of the transactions would go without exposing to tax reduction, even though those are chargeable to tax in India. So the process should be followed like that. In case I made payment directly to the third party and not made this reimbursement to my group company, whether the transaction was taxable in India or not. Say, for example, if rather than making payment to my group company about the reimbursement, I would have made payment directly to the ultimate entity who has provided me the support services, whether those support services were taxable in India or not under the Income Tax Act or the relevant treaty as applicable to that entity. If the answer is no, you can safely take a position that yes, the underlying transaction is not taxable and this is a cost to cost reimbursement, therefore no tax liability or TDS should be there. But if the underlying transaction is taxable, then the argument of cost, to my mind, should not come to rescue you, because then it would be that if I make payment directly to a entity and that is taxable in India, I can always have an intermediary entity who would take the services and would provide me the services, and then I'll be making payment of reimbursement and taking an argument that it is a cost to cost. So focus on the underlying transaction, whether that is taxable or not. If that is not taxable, you are safe. If that is taxable, then to my mind, cost to cost reimbursement argument may not work.
Thank you, sir. The next question is of Lokeshwar S. He's asking, under section 195, subsection 4, where ITO has cancelled the certificate prior to validity period due to some reason, but during the tax audit, client has not disclosed the fact. In such case, do we have alternate checkpoint that where we can see the status of such certificate, validity of income tax web portal, meaning to say professional skepticism?
Yeah, I think that's a good point. And the answer lies somewhere in the practical aspect of it. And I would need help, Akshay, from here, because
Yeah.
to my mind, that when we as a payer, when you file your TDS return, and then you will have to provide your TDS certificate number also, withholding tax certificate number also, and then it gets validated. If that has been cancelled in the system by the assessing officer, then while generating the TDS return, you will have the error. So that would be the point. Yeah, Akshay.
Yes, I think, Nitin, yes, that would be the process. But of course, there can be, a very valid question from a practical side, because there can be certain instances wherein there is a delay between when the certificate has been cancelled and when you're filing the return. So if there's an overlap, then yes, maybe you may not have be able to get that answer. But yes, one of the ways or the practical side to it is when you're filing a TDS return. But the downside, Nitin, there would also be that the TDS return would also be filed by the assessee himself, who is not actually disclosing that the certificate has been cancelled.
No, so so take an example that if certificate says X amount and you are applying in the TDS return that X amount and providing the TDS certificate number also, then while doing the validation of the TDS return, you will get the error.
We would get the error.
Certainly, there has to be a time gap.
Ah.
Otherwise, if it is not reflected in the system, then it may not. But you can also see that the event, and when you are doing the audit, if there is a time gap, to ask that if they have received any notices also, because then they would be receiving some automatic notice from the department that there was an error in your TDS return. You applied this certificate, whereas this certificate was cancelled. So one has to do some diligence. I understand that maybe in certain cases you may not get to know that whether certificate has been cancelled by the assessing officer, and if that fact has been hidden is not disclosed by the payer who is your auditee.
Also, can I take the next question now?
Yeah, please.
Thank you, sir. So next question is of Rajni Thanvi ma'am. She's asking, can you please elaborate the meaning of gross basis and net basis tax rates?
Yeah, okay.
So
yeah, let me take it up.
Sure.
So gross basis, if you are making payment for any stream of income, which can properly be classified as interest, royalty means for patent, copyright, trademark, etc., or technical services, which is managerial, technical, or consultancy services, then you apply tax on the gross sum. So you are making payment of 100 rupees for a technical consultancy, and under the income tax law, the rate is 10% plus cess and surcharge. It comes to say around 11%. Under the tax treaty, the rate is 10%. Then you apply 10% on the 100 rupees, which is a gross basis taxation, and you are applying tax rate on a gross basis. So you will apply 10 on 100 rupees, you'll deduct 10 and deposit with the government. Sorry, for a bad thought. Whereas net based taxation is that the recipient of income has a presence in India. And if it has a presence in India, it has a project office or a branch office, or they found some employees here in India. They may have a business connection or a permanent establishment in India. If they have that, then it will not be a gross basis taxation that you will apply 10 or 15 on the 100 rupees. They will have to prepare their profit and loss account. They will have to claim expenses. Then on the net profit, you will have to apply the rate which is 40%. So 40 is the tax rate which is applied on the foreign companies or foreign nationals if they have any presence in India. So if out of 100 they claim 50 as an expense, on the balance 50, it would be 40% or 42% tax rate would apply. That is a net based tax rate.
Thank you, sir. So next question is of Amir Khan, sir. He's asking, if an NRI swift to India and get transfer all his money to India for doing business, then is there any compliance of TDS? Plus, if an Indian company remit amount to Indian, I guess this will be gone, Indian government for office establishment in foreign country, then such transaction is liable for TDS as amount transfer for office establishment.
I think there are two questions asked. One, that NRI is coming into India and bringing money into India for starting some business venture.
Yes, sir.
And so, sorry, I'm not able to fathom that how who is making payment to who. If NRI is bringing money into India for starting a business venture, then payment is kept by the NRI. Then who will make payment? Sorry, so I'm not clear on this question.
So
Yeah.
so should I repeat
Maybe if you
again?
can yeah, please.
So first question is, if an NRI swift to India and get transfer all his money to India for doing business, then there is any compliance of TDS? This is the first question, sir.
No, because you are not making payment to any non-resident. So one, that you are a NRI, so under the income tax act you are non-resident. You are not making payment to another non-resident, which is chargeable to tax in India. So there should not be any occasion to attract 195 on those transactions.
So second question is, if Indian company remit amount to Indian gone for office establishment in foreign country, then such transactions is liable for TDS as amount transfer for office establishment.
Yeah, I think now it has recently been introduced, and actually you would come in that for liberalized remittance scheme, if you are remitting some money outside India, then those are liable to TDS provision also. Yes, it was not there earlier, but from this year it has been introduced.
Thank you, sir. So next is CA Vaibhav Kedia question, sir. From 10F is not mandatory if TRC is provided. TRC from many countries don't contain address of the assessee.
Yeah, so I think this was highlighted by Akshay that you should have TRC in your file. If TRC doesn't have all the information what is contemplated under Form 10F, then you should have 10F also. But if TRC has all the information which is desired under Form 10F, then there is no requirement to have 10F also.
Okay, thank you, sir. So next is Sandeep Pathak, sir. He's asking, he missed the full form of CTA.
CTA.
Yeah.
Covered tax agreement.
Okay.
Thank you, sir. So next question is of again CA Vaibhav Kedia, sir. He's asking, when there is bouquet of services like financial consultancy, IT support, HR consultancy, and so on, what should be nature of remittance as per IT Act and purpose code as per RBI?
So for the income tax, you will have to make an assessment that whether the payment would fall in technical services section 917 or say the relevant article of the tax treaty, say for example article 12 as the case may be. And then you have to make an assessment that what is the predominant character of those payments. As far as RBI is concerned, I think the the best friend for you is the AD banker, who can certainly help you figure out that which particular classification those payments will fall in.
Thank you, sir. So next question is of K. Srinivasva. Sir is asking, if I receive any income to do service in the foreign university, whether such amount is taxable or not.
So you as a resident, if you receive some amount for rendering services in foreign university, you are a resident, you are liable to pay tax in India on your global income. So certainly you are liable to tax in India. Your taxability in the foreign country where you are rendering services would need to be seen in the context of the local laws of that country, as well as India's tax treaty with that particular country, that whether this stream of income can be taxed there or not.
Thank you, sir. So next
But
question is
in
of
case, just to add that, in case you have any tax instance there in the foreign university or a foreign country, whatever taxes you pay there, you can always claim tax credit for those taxes in India.
Thank you, sir. So next question is of Sachin Goyal, sir. He's asking, if a person who is not employee but consultant of a company is sent on foreign deputation, whether the same would be treated under salary provisions or technical consultancy for TDS provisions.
So this is a very contentious subject, that whether a consultant should have, say, 194J as against 192. 192 applies on employees. The judicial precedent suggests that you have to see the arrangement with the consultant, whether the consultant is subject to the same rights and obligations what the employees are, then it is a de facto employee and provision of 192 should apply. So if the policies like leaves, absences, retirement benefits, rights and duties, etc., are same as you apply on your employees, and those are being applied on the consultant, then consultant should be considered as employee and to be seen as taxable under 192. Again, if the consultant or employee has gone outside, one has to see the residential status of that employee in a particular year, whether it is a resident or a non-resident. If it is a resident, it will remain taxable in India. If it has attained non-resident status, then it will be taxable in India only for the India source incomes.
Thank you, sir. We are like done with the questions. Some of them are repetitive questions, and the chat box is full of thank you messages. At the end, I just want to like to thank you, sir, for being such a great resource person, for explaining the concept of taxability, remittances, and all a lot in detail with very calm and force, answering all the questions. It's been pleasure to have you, sir. And we are also thankful to Anand, sir, for giving his time to us. Thank you, sir.
Thank you very much. And thank you so much for giving us this opportunity to share our thoughts here and connecting with the fraternity. Thank you so much for organizing this. And I think this is a wonderful thing we are doing, sharing our thoughts and subject matter expertise, and learning also while addressing these questions. So there is a lot of learning we also capture. Thank you so much.
Thank you, sir.
Thanks a lot, everyone.
Thank you, everyone. And to all the participants, we will start our session exactly at 12:30. Please join on time. Thank you.
Thank you, everyone. Have a nice day.
Thank you, sir.
Bye-bye.
Should I end the session, ma'am?
Restart कर लेंगे बताइए.
Yes, yes.
Okay. Participants, we will restart the session sharp at 12:20 or 22. Please join by that time.